A weak jobs report rattles U.S. markets. Michael Landsberg of Landsberg Bennett Private Wealth Management joins us. Michael, we had the non-farm payrolls report today. 22,000 jobs added in August. That's way below the average estimate, which was 75,000. We've seen various data showing us that the labor market is slowing. But what did you make of today's non-farm payrolls report?
It wasn't a good number. I think, again, most people had expected, some weakening, but I think this is a huge drop from what people expected, which I think has led to some of this market reaction. I think the concerns are how long does this go? And, is it something that the Fed is, in front of, or are they playing catch up again?
Earlier today, bad news was good news for stocks, which rose after the jobs report because investors saw this as cementing a Fed rate cut. But now stocks have reversed those gains. So has the calculus changed?
I think what happens is I think initially it was, hey, we're going to get some rate cuts. It's positive. The market rallies. I think then the reality set in is, well, maybe this is the beginning of a bad trend. People wanted rate cuts because they wanted rate cuts. They didn't want the economy to soften dramatically. I think that's really the issue I think people are faced with. I don't think you can glean a lot out of one number. It shows you come to the volatility that we've got. But I think it's one of those things you got to keep an eye on. Is this a trend that continues? On the unemployment rate did bump up a bit, so it's a concern. And obviously they revised the number negative back a couple months ago. We haven't seen that in over 4 years. So there's a little bit of some storm clouds, if you will, that I think people have to pay attention to. But for the most part, we think we're in pretty good shape, earnings wise.
So it sounds like you don't see a potential recession back in focus.
We don't. I mean, we think actually growth's going to accelerate, back into let's call it the fourth quarter and first quarter of next year. We think inflation will reaccelerate a bit here. And I think that's actually, okay. The Fed never seems to be able to get it to 2. I mean, last year about this time, it was 2.44. They expected it to go to 2. We thought it would go to 3. It got to 3 and then above. We think we're in the same scenario. We got here to this kind of low point. We think we'll start to reaccelerate back up. But earnings have been really strong, Lisa. And that's really at the end of the day what stocks trade on. Earnings were up double digits again, S&P year over year, where the street was at 2%. The earnings came in nearly 13. So they're nowhere near where they need to be. I think they're too negative, and I think that's an opportunity for investors.
Well, getting back to the Fed is more now on the table, even a jumbo 50 basis point rate cut in September, followed by a succession of more rate cuts.
I think everything is somewhat back on the table. I think what's going to happen is this kind of an odd thing. The president has been pushing for rate cuts for a while. I think if you start to see a weakening in the jobs number, you're going to see the Democrats also push for rate cuts. So I don't necessarily think you're going to get 50 at this first one. I think they've been so data dependent and so slow to move. I'd be a little shocked if we got 50 right away. But I think if you get 25, and I think that if the labor number continues not to impress, I think you get more people on both sides of the aisle pushing for it, and you could see more. Typically, Wall Street exaggerates how many rate cuts you think you're going to get. We saw that before where we had 7 priced in and they got 2 or 3. So I think that's kind of what I think is going to happen. But I do think you might see some pressure if the labor numbers don't get any better.
So take us into next week when we get more inflation data with the consumer price index and the producer price index. They've been hovering, high 2s, low 3%. Is there some number where they really tick up where the Fed has to say, whoa, or is the Fed just saying, okay, inflation is hanging out there and we're now just really focused on the labor market?
I think it's probably the latter. I think what's going to happen is I think inflation might tick up a bit, but I think they've kind of switched their mandate now a little bit more towards emphasizing labor. And I think that's the issue. I think even if inflation ticks up a bit, which we expected to tick up a touch, it's not going to be that significant. Maybe if it goes up 10, 12 basis points from where we were a month ago, I don't think that's going to be a huge detractor. Now, I think what it will do if we see it for a few months in a row, that may, what we think is going to happen is going to pause some of those later in the year cuts. But I think for September, they cut 25. I don't think anything really derails that. I think what you could see is if inflation starts to kick back up later in the year, I think that's going to be a tug of war between the Fed is what mandate are we looking at? Are we looking at jobs getting weaker? But if inflation's going up, how do you kind of gauge that? And that's going to be threading the needle for the Fed at that point.